So what are we covering here today? We have a pretty packed agenda. To start off, we're going to mention who we are, Stonks Society, a little bit more deeply. We're going to talk about what you should do if you're a brand new Stonks Society member and if you're a brand new trader or investor. We're going to talk a little bit about what is investing. We're going to talk about what trading is, because they are different. We're going to mention basics on stocks and then talk about option basics. I'm going to briefly talk about the mental game, which is a huge part of trading. And then I'll give you some very high-level overview of what charting is like, the basic idea of it, essentially. And lastly, perhaps even most importantly, since we are an option-focused trading Discord, we focus on giving you high-quality alerts, essentially signals to buy and sell. So we'll teach you how to read these alerts as well. And I'll give you some closing remarks. We'll have a Q&A session at this as well. And if you're down, you can stick around, and we'll also be having a Senpai will be taking over, or as you can see, Ethan Chan there, and he'll be doing a more focused segment on preparing for this coming week's technical analysis plays. Okay, so what is Stonks Society? We are, like I said, Discord, and we focus on high-quality trade alerts on stocks, options, and Forex. We mostly focus on option speculative trades, which means there is potential for huge wins, and we use risk in order to mitigate any sorts of losses involved. We also provide our members with a lot of these buy and sell signals for all these stocks, regardless of whether or not we're actually trading options on them. As I said, there's a lot of stock positions that we actually get in on that we just simply don't trade for options just because of any volatility or liquidity issues, stuff like that. We also have a website I've put in, pretty simple, stonksociety.com. That's where you can learn even more about our group, and you can also purchase a membership if you'd like. Not going to put it down that you have to. In fact, I actually suggest you join the Discord first to see what we're like as a group, chat with us, stuff like that, and then you can decide from there. Always remember that there is a free plan for Stonks Society. You do not have to pay to be a part of a group. Please note that by engaging with any Stonks Society channel, event, or member, you are acknowledging and agreeing to the disclaimer that's in the disclaimer channel on the Discord. We also have a proven track record of our plays. They never guarantee profit, and there is no guarantee of freedom from loss. Lastly, you are solely responsible for your own decisions, whether it results in a gain or loss. I know those last three bullet points were like a little bit too law litigation type stuff, but it's important for you guys to understand that we're not here to manage or control your money. Your money is your money. If you earn 100% on your money, it's all yours. Congratulations, and run with it. But just remember that if you do have a loss, it's also yours. So just own up to it, and we'll learn together, we'll improve together, and I'm sure we'll be able to make some nice gains. Okay, so what should you do if you're brand new to Stonks Society? Maybe you've been trading by yourself, maybe you haven't, but you've just discovered Stonks Society, or you've just discovered our Facebook or Instagram or our website. First thing you should do, join the Discord through the link that I just sent in the chat, and read and react to the disclaimer message in the disclaimer channel. It's hard to miss. You want to do this because it grants access to the server. Gives you a lot of channels that you can use to talk with us, and there's alerts and stuff like that. Then you also want to visit the server contents. That gives you more information on all the channels we have to offer. Granted, not all of them will be available, but you can unlock them if you'd like by purchasing a membership. Not necessary, of course, if you'd like to stay on a free plan. The trading floor is open for us to talk about market-related things during market hours. And after market hours, it's pretty much just anything goes, really. So it's pretty casual for us. Member Plays is where we get to have premium members post their own alerts. And oftentimes we actually have members use those trades amongst themselves. So not every alert that's taken is an official alert by an analyst. Sometimes you might have a friend who has gotten some pretty good plays, and oh, maybe this guy's really good at Boeing. Then you'll maybe follow his Boeing plays instead. And it offers an opportunity for everyone to become an analyst at their own experience levels, etc. And it just allows us to all really understand where we are in our journey of becoming more experienced traders. Please remember though, there are no questions or chatting allowed in this channel. We want to keep it nice and simple and to follow, which means you should only be posting in that channel if you're opening a new position, closing an existing position, or updating an existing position. Few more things to get out of the way before we get to the good stuff. If you ever experience any server, role, or membership related questions, we'll definitely get to you. Best way to do that is to actually open an official ticket in the support ticket channel of our Discord. That allows us to track the issue you're having and for us to solve it in a timely manner, as there'll be a lot of people who are able to help you. Again, this is a free Discord, although if you'd like official alerts by our analysts, you can purchase a premium membership for a small fee per month, and go ahead and visit the StonksSociety.com website to view membership plans. Okay, so let's say you're brand new to trading, which probably also means you're brand new to the Discord as well. In that case, first thing I'd say is choose a brokerage. This might require a lot of time for you to figure out which brokerages are best for you. A brokerage is just simply a company that you can make an account with that then allows you to make trades and investments across many different security types. Could be stocks, bonds, options, Forex, you name it. And in order to do this, you have to have a registered account in that brokerage. So here are some examples of common brokerages that we use in the US, even Canada, and a couple other nations as well. TD Ameritrade is a analyst recommended trading platform. I use it. I know our founder Senpai uses it. You'll know him as Ethan in this chat, and all the other analysts use it as well. So TD Ameritrade is really good in my opinion. Interactive brokers, I've heard good things. Fidelity, Schwab, E-Trade, TradeStation, all of those are vetted big names out there. So if you got an account with them, you're in good hands. Robinhood, not gonna lie, I have one. Most people have one. Robinhood is a very easy to pick up platform. You can hit the ground running and be trading the same day. I don't recommend doing that all the time, especially if you're new. But it's something out there because everyone has it. Almost everyone has it, and it's easy to understand. There's less time involved to learn the platform. At any rate, once you've picked a brokerage and you've registered, then you just transfer money from your bank account, it could be checking, savings, whatever, to that brokerage. Let's say TD Ameritrade. Once you've done that, you can choose optionally to be granted access to options trading with your brokerage. Typically, when you first get your account, you do not have access to options. You have to specifically request access with your brokerage, which typically involves answering a few questions and involved with your risk levels and stuff like that to see whether or not you're at a good position to be taking options into your account. And this is an important point. Regardless of whether or not you use options trading in your brokerage, you should learn your brokerage to a decent degree before making trades. This is at the very minimum learning how to buy it and open a trade and sell a trade or to close a trade, for example. You might also want to take a look at how your brokerage can allow you to look at charts, which allows for technical analysis. And we'll get more into that later on. And for you guys who are new, markets are open from 9:30 a.m. to 4 p.m. Eastern Time, USA, Monday to Friday, except bank holidays. So for example, upcoming Christmas will be closed. The banks will be closed and you will not be able to make trades on that day. There's not too many bank holidays, you can feel free to look them up. But I'm sure that if you're here long enough, we'll be chatting about it in the Discord anyways. Again, if you're new, it's a difficult type of adventure. And if you'd like, you can feel free to join us with the premium membership. And you can see that website right down there at the bottom. That'll allow us to help you kind of cross the seas together, make it a little bit easier of a journey for you. Okay, let's go on to investing. Investing is the most common word we throw around, and it's done by almost everyone. Probably your parents have an investment account. If you have a 401k, an IRA, those are retirement accounts. Those typically use this type of strategy called investing. Investing is definitely a good strategy. Almost everyone should be doing it to some extent. Investing is good for longer term outlook. Your time horizon, right? How long do you expect to get to your goal? If your goal is 100%, if your goal is 200%, it's all great, but it depends on how long it takes for you to get to that. If you're okay with it taking 10 years, 20 years to get to that final goal, then investing is a great strategy because it's safer. Let's go a bit more into it. When you invest, when I say I'm investing, it typically means that you're holding something for many months, years, or even decades. So it's quite a while. Some people buy when they're 20 and never sell until they take it out of their retirement account when they're 70 years old. So it can be quite a while. Investing also focuses more on fundamental analysis. What's fundamental analysis? That involves analyzing quarterly and annual reports from a company, because a company that's publicly traded is lawfully required to submit these reports about their company. Really, really in-depth stuff. And you can learn about what they're doing, how they did this particular 3 months of the year, or how they did this entire year in comparison to prior year, stuff like that. Another part of fundamental analysis that's very important is company management. How is the CEO doing? The CFO, CTO. What are the risks involved with, for example, cyber attacks, stuff like that? Or perhaps, for example, another method of company management is seeing how the CEOs get paid. If their payment model is a little bit whack, that could be grounds for potential future law issues, right? Class action lawsuits, for example. You would also take a look at competitive analysis. If you guys know SWOT, for example, it's a very common fundamental analysis technique. I won't go into that today. You can look it up later. But comparing this company to other companies is a great way to start understanding what it is exactly that makes this company better than the other one. Why should you invest in this one for 10, 20 years, right? Because if you're wrong, you lose 10, 20 years of time. It's a big deal. And lastly is business model. What are they trying to buy? What are they trying to sell? What's the whole deal? Why my company? Why your company? That's the basic of it. And how they do it. Moving on, we're talking about the idea of buy and hold. Typically, when you go out to the world and they start talking about investing, and you're seeing these articles by CNBC or The Balance and Investopedia, buy and hold at some point will probably come up in your repertoire of words to use. It's a very simple strategy. You buy and you hold. Doesn't matter if it goes down, doesn't matter if it goes up, you hold through all of it. And this is a very basic idea of investing. You put your money in with the assumption that putting the money in now will be strong for the future, because, as they say, time in the market beats timing the market. That's a commonly thrown around phrase that just simply means that it's difficult to time the market. And if you're wrong, you can oftentimes lose a lot of money in comparison to if you had just bought and hold. So there is upside, but it's riskier for those who want to do something that's not investing. Keep in mind that most investment management firms and even people like Warren Buffett, the big guy out there, they all use fundamental analysis and investing techniques. For example, one type of fundamental analysis technique is called value investing. Value investing is just simply buying undervalued companies, which can be spotted based on fundamental analysis. All right. To sum up investing, I would say that it's good because profits are slow but steady, and you're also more likely to be profitable. So people who are less okay with taking a loss, investing is a good way to go, because although you won't be buying your next Lambo anytime soon, it also does more likely guarantee over the course of multiple decades that you will be able to make money. Now let's compare that to trading. Trading, as you may have guessed, is shorter term. You can hold anything between seconds in what you call a scalp trade to a few weeks or a couple months, what you call a swing or a medium term trade. Trading more focuses on technical analysis over fundamental analysis. What is technical analysis, or TA? TA mostly focuses on using charts. It studies historical price data of the stock in order to suggest potential future moves on the stock. We also use indicators, which we'll get a bit more into. We'll use price action, which is, again, studying how the price moves and the trends of those prices. That's the basis of technical analysis, and there's a lot more that goes into it that can be quite quantitative and data-y, but that's the basics of what TA is. Okay, and how that easily compares to FA, or fundamental analysis. Now, traders believe in what you call market timing, which is the opposite of just putting the money in at any given time and just letting it sit. Market timing can be riskier, but if you are correct, the profits come way faster and way larger in comparison to trading. In comparison to investing. So that's why this is a good strategy. Trading is a good strategy for earning additional income to pad on whatever you are already making during each year. So you can see that there's different strategies. Investing, good for long-term retirement. Trading, good for earning additional income. Okay, so let's talk a bit more about stocks. Most of you probably already know what a stock is, but I'm going to go through the basics of what that means. When you're owning a stock, or when you are buying a stock, you are essentially buying a really small piece of ownership of the company. Sounds crazy, but you're actually truly buying a small piece of the company. If I bought a little bit of Apple, that means I own Apple a little bit, not a lot, but I do own it, and that's something to really to be proud of. Think of this as a company pie. Let's say a company A has 100 shares. So if you buy one of them, you own 1/100th of the pie, meaning you are a 1% shareholder, and you own 1% of the company. 99% of the company is in other people's hands. Perhaps, for example, 51% goes to the CEO, and another additional 48% goes across other shareholders, for example. So something like that would be an example of how stocks work. Once stocks become publicly traded in what you call an IPO, or initial public offering, it then becomes a stock or a piece of a company that you can then buy and sell multiple times throughout the day, every single weekday. And this is what you call the secondary market. The secondary market does not immediately affect the company, but there are repercussions if the secondary market of stock price for that company does not do well. And for stocks, there is a minimum price, which is above $0.00. If your stock is worth nothing, that essentially means that your company has gone bankrupt. And if you're trying to buy stocks, which is typically what most people do, you wouldn't want that, because you would lose pretty much your entire investment. Keep in mind, it doesn't have to go to $0.00. If it gets too low, it goes into what you call a penny stock territory. Something that's like 60 cents on the dollar, or $1.50. That's the kind of area where you want to be careful buying, because penny stock typically has issues being a stock that's held across many institutional funds. And you want the big boy money, the billions of dollars of investments that the big companies make, and you want to typically follow those in order to not make too risky of an investment. So how do you profit on stocks? You profit on stocks when you buy low and then later on sell high. That's typically what you call going long. Because you are bullish on the stock, you expect it to go up in value. You can also profit when the stocks go down. You can sell high and then buy back lower. That's what's called shorting. And in that case, you'd be bearish on the stock because you expect the stock to go lower in price over time. Like I said again before, companies do seek to increase their stock price, ideally, as they have a fiduciary responsibility to shareholders. In other words, they just, that's their real goal, is to improve shareholder value, for example. Let me do a quick stop and check the chat and make sure nothing is too weird. All right, I'm going to trust you, Ethan, to make sure everything's good. Just let me know if something's wrong in the audio or any sort of visual issues. All right, so moving on to options. Options are a much more difficult version of stocks, and I will not, it may take you quite a while to get used to how to properly use options, but we'll be there to help guide you through the process. Here's the basics. An option is denoted in not in shares as you would with the stock, but rather in contracts. And a contract of an option or an option contract allows you to buy or sell a stock at a set predetermined price at a predetermined expiration date in the future. It is not the guarantee that you will buy or sell these stocks. It just gives you the right to do that. Okay. Options derive their value from stocks. That's why you call it a derivative of stocks. Being a derivative, it essentially means that if the stock price moves up, typically the options can move up or down depending on the price. And then if the stock price reverses and goes down, then that also affects the option prices. The options don't affect the stocks as much as the stocks really affect the options. And we'll go into why exactly that is. Now, when options were first introduced many decades ago, their focus and their real goal was to be used to hedge, or in other words, to protect existing stock positions. So if I have 100 shares of AMD, you could, for example, buy or sell options in order to protect your stock position from losing value. However, over the years, option speculation became a thing. And option speculation is quite profitable because if you're not using it to protect a stock position, options in and of themselves can swing very wildly up and down, and therefore can be extremely profitable. But of course, it comes with higher risk, and so buyers and sellers also must be beware. For example, a common option that is slightly riskier, what you call out of the money, we'll talk about that later. If it expires sometime this week, for example, this Friday, December 18th, 2020, those options can swing up or down 100% per day, for example. You could literally make 100% on your money in a single day. However, again, that does not come without the equivalent risk involved. Be aware that if you are an option buyer, that is, if you're buying options of any type, aka long options, that is a negative sum game. And we'll explain more why that is, but essentially it means that if you buy options more and more over time without something that allows you to be more profitable, such as, for example, better information or better trades, less risky trades, stuff like that, over time you technically do lose money. So you have to be careful and have something that allows you to keep your skin in the game. And we'll talk more about that later. As I also had previously mentioned, there was an expiration date. So what happens at that expiration date? What happens when options expire at that date is that they become worthless unless they are in the money. I should probably have changed this to say all options are worthless if it is not in the money by expiration date. And we'll talk more about what that in the money means. Just know for now that option contracts are represented by 100 shares of the stock. So if I own one option contract of Apple, that also means I am buying the right to buy and sell Apple equal to 100 shares at a predetermined strike price at a predetermined strike price that I will explain later right down here. The strike price is a specific price that you can exercise your contract. Exercising your contract just simply means to putting into effect the right you are buying to buy or sell shares at that price. It is quite a lot to swallow, I understand. So I don't expect you to get all this in the first go if you're new to options. But the most important thing to understand is that it is a derivative of stocks and that you can buy or sell the right, and this right has an expiration date, which makes it riskier. Please note that options do not represent ownership of the company. When you're buying an option, you are not buying a share of the company like you were with stocks. That's an important thing to understand. You are buying the right to buy stocks, not that you are buying stocks. The last thing I'd like to say here is option premium is typically where you'll hear in our server. Premium is just simply the price of the option. Nothing difficult with that. And remember, there may be a lot of questions involved with this slide, I understand. So feel free to use that Slido that I had posted either at the beginning of this presentation, or you can use the one that's in the Zoom chat. I've posted this Slido there. Feel free to put in your Q&A and upvote other people's questions that you see fit. Okay, so let me do a quick check on the chat. Okay, perfect. Looks like it's fine. Moving on, there's two types of call options. Or, sorry, there's two types of options. There's call options and put options. It's that simple. There's only two. The first type of option, called a call option, is buying the right to exercise and buy 100 shares. And a put option is where you buy the right to exercise to sell 100 shares. The interesting thing about how shares work that I had alluded to before is that you can actually sell shares without having to owning them in the first place. That's essentially what shorting is, by selling shares you don't currently own and then buying them back later. So put options is a little bit more confusing in that sense, but it takes into account the ability to short shares, and that you're buying the right to sell those shares at a set price. So an example of how you can earn money with, let's say, a call option. So let's say that I am buying an Apple contract, the right to exercise 100 shares of Apple at a set price. Let's say that my Apple strike price, aka the set price that I can buy, is $100 per share. And let's say it expires this Friday, as I said earlier, December 18th, 2020. That means that as long as Apple's price stays at or above $100 per share at expiration, which is this Friday, then my call option is worth money, and more specifically, that I can choose to exercise my right to buy 100 shares of Apple, not at the current price of Apple, but rather at the strike price of Apple, which is $100 per share. So if I'm buying 100 shares of $100 per share, that's $10,000 investment. Does that mean I have to put this $10,000 investment every single time I buy Apple shares or Apple contracts? Absolutely not. When we're buying and selling options speculatively, you do not need to actually exercise your right. You only need to own the option to exercise and then sell that option to exercise back to the market. That allows you to not have to front tens of thousands or hundreds of thousands of dollars of capital every time you buy a single contract. That's a very important thing to understand about options. Now, moving on, how are options priced? What is it? Why is it even worth anything? So let's go into it. Options can be worth something due to extrinsic and intrinsic value. And depending on whether they're in the money, at the money, or out of the money, you can assign value to it. What does in the money mean? In the money options simply means that your options are currently worth something if they were to have expired right now. So let's go back to the Apple 100 strike example. Because Apple right now is trading at about $120 per share, and my call option on Apple, for example, was $100 for the strike price. That means I can buy 100 shares at $100, which is a better deal than buying those shares at 120, which is what they're currently at. Because I can buy each share at a $20 discount, my current Apple option is worth money because I can buy it for cheaper. It gives me the right to buy Apple shares cheaper. This is what we call intrinsic value. Okay, intrinsic value is, like I said in this example, the price of Apple is at 120, but I can buy it at 100 because I have the right to buy it with that call option. That's intrinsic value. So what's extrinsic value? Extrinsic value is a type of option value that all options have, regardless of what their strike price is or what their current share price is, as long as the option hasn't expired. So now I'm going to talk a bit about at the money and out of the money. We just know that in the money so far just simply means that it has value if it were to simply expire right now. At the money simply means that the strike price is the same as the current share price. So in the same example, if Apple is at 120 per share, if I had a 120 strike price of Apple, that's what you would call at the money. It doesn't have intrinsic value, right? Because I could simply buy shares on the market right now for 120, or I could exercise my option to buy shares at 120. Doesn't make a difference. You're still buying shares at $120. That's why there is no intrinsic value, and that's what you call at the money. Out of the money means that if the option were to expire now, you get $0 back. If, right? So back to my example, if Apple's at 120 per share and my option contract is a 130 strike price, that gives me the right to exercise to buy 100 shares at, you guessed it, $130 a share. So if it were to expire now, my option right were to expire now, for example, would my out of the money option have any value? The answer is no. And I'll tell you why. That's because by having the right to buy shares at 130, no person in their right mind would ever do that, because they could just simply go to the market and buy them individually per share for 120. That's $10 cheaper per share, right? Why would you intentionally buy a share that's $10 over the current market? You wouldn't. And that's why an out of the money option only has value if it hasn't expired yet. So again, in the money has extrinsic and intrinsic value. We'll talk more about what makes up extrinsic value, but for now, just be aware that it has value even if it currently is not in the money. And the reason is just simply because there is time involved. Okay, so what is extrinsic value made of? Mostly time value and implied volatility. Now, I haven't quite talked about implied volatility yet, but I have alluded to time value. As I said before, if that out of the money option, that 130 strike, were to have expired right now, for example, then it would not be worth anything because there's no more time left on it. Now, again, no one would buy it at $130 a share, but there's still value in having the right to buy it at 130, because between now, Sunday evening, until Friday afternoon, that's a whole week of trading at which Apple could go from 120 per share to 130 per share. And if it does do that, then that out of the money option now has value because it would be at the money or maybe even in the money. Okay? All right. Okay, let's talk about implied volatility, because as I said, extrinsic value is made up of time value and this other thing called implied volatility. Implied volatility is what the market expects a future move of the stock will be. It measures the expected volatility of the stock over the lifetime of an option. Another way to say it is it measures how quickly a stock will move. Potentially, the market expects how it will move in any given direction. It doesn't matter what the direction is, it just matters the speed at which it does so. You can also use implied volatility, or IV, to see what the market forecasts future stock price movement could be. So if it's a really, really high IV, or implied volatility, the market expects that it will be fluctuating a lot, which means you could gain and lose money very quickly. Be aware that having higher IV also makes option prices expensive, all else equal. So, for example, I could have two stocks. If you take a look at the graph below, let's assume that we have stock B for black and stock R for red line. Let's assume that these are this is the price fluctuating, and I'm just graphing it over time. Yes, and you can see on the right-hand rail we'll have example numbers given the prices for each share. So stock black, or stock B, is pretty flat, right? It hasn't really gone anywhere. It's kind of pinned to this sort of $120 a share. But stock R, or stock red, went from 110 towards the bottom of that graph all the way to 145, then back to 110. Now notice that neither stock really went anywhere, right? Over the course of this time, the stock essentially had 0% change, pretty much. But because the red line went really up and then really down very quickly in the same amount of time as the black one, which was, pretty mellow, you would expect that the red stock, or stock R, to have higher IV. And higher IV means they're more expensive options given the same thing. So you could choose the same strike prices. You could choose the same expiration dates, but you can have different premiums due to having higher or lower IV levels across the stocks, even though the stock prices are as if they were to be the same. Okay, let's talk about the Greeks. Now, this can be another depth of understanding for options, but it's very important that people who are new to options understand what the option Greeks are, because that is the main area for how options change in accordance to the stock. Remember, in the beginning of the presentation for options, I said that options are a derivative of stocks. So now we're going into how they are a derivative of stocks. So let's start off by saying that option pricing is based on a complex pricing model. It's called the Black-Scholes model that was developed, I think, in the 70s. Don't quote me on that, though. Essentially, two guys came together and did a lot of mathy stuff and discovered that options can be priced based on certain values, variables, if you will, which you can call Greeks. And these variables help factor in the current price of the option, which can change every second, even faster. I want to focus on three main Greeks today. I understand they're not actually part of the Greek alphabet except for delta, but bear with me, that's how they say it in the real world. There are more Greeks than this, but these are the main three. The first one's called delta. This is probably one of the most important ones. Delta is just a Greek that tracks the change of the option premium, or the option price, as the underlying stock changes. So for every dollar the stock increases, the option contract you could be holding increases or decreases the value equal to the delta. Let's bring an example in. Let's say that the delta is 0.5. So if that's the case, if I'm owning an option call contract, a call option on a particular stock, let's say Apple, and I have a delta of 0.5, that means that if Apple's price were to go from 120 to 121, then the delta of 0.5 gets added to my option premium, or option price. So for example, if I had bought this particular contract for, let's say, $100, 0.5 denotes $50, which means that it would have increased my option value by $50. And the reason why it's $50 and not 50 cents is because, as I said in the beginning, options represent the right to buy or sell 100 shares per contract, which means every option premium is listed as one share. You have to multiply it by 100 to get the full lot value. And this is just how they denote Greeks and premiums in the real world. So I'm just kind of following that by saying delta of 0.5. But let's reverse it. Let's say Apple goes from 120 per share to 119 per share. So Apple goes down by $1, then my call option on Apple decreases by $50, or potentially a little bit less, but I won't go into the specifics of that. And be aware that if I were to flip it and use put contracts, deltas are typically negative for put contracts, which means that if the stock price were to increase from 120 to 121 on Apple, my put contract decreases. Why is that decrease? Because the delta is negative. So if I have a delta of negative 0.5 for a put contract, if the stock of Apple goes from 120 to 121, I lose $50 with the negative 0.5 delta. Remember that a put contract is essentially being bearish or being short a market without actually owning the shares. Owning a call contract, on the other hand, is being bullish or expecting the price to go up over time. Okay, let's move on to theta. Theta simply tracks the decay of the option. Remember when I said that all options have value at least because of time? Time is a huge reason why many options have value regardless of the strike price, no matter how crazy up or how crazy out of the money they are. Options still typically have money or are worth value because of time value. And theta simply tracks the speed at which that time value goes down or decays. So for every day that passes by, which includes the weekends, long option contracts holders will lose value equal to the theta. So if my theta was 0.2 and I own that same Apple contract, that means tonight, Sunday, I'm losing $20 on my option contract. Come Monday night, I lose another $20. Tuesday night, another 20, and it keeps increasing over time. In fact, the closer to expiration period you are, the more the theta is in comparison to your contract price, which also makes it extremely risky when you buy close expiration contracts, because time decay is a huge factor you have to think about, because all that's left is mostly time. If your option is not in the money, then you're just going to be worth very little, because you have less and less time to give your contract to become in the money by expiration. So when you are an option buyer, that is when you are buying call options or buying put options, theta works against you. You have to be careful about that. Time decay will always be eating away at you, so you have to be thinking about theta over all the time. And now let's go with the final Greek, which is vega. Remember when I talked about implied volatility in the previous slide? This is where it factors in. Vega tracks how sensitive an option is to implied volatility. So if implied volatility were to increase by 1%, then the option value will increase by what you call the vega. It's interesting to note that vega differs from delta here, because if volatility increases, IV, it increases the contracts for both puts and calls. Whereas for delta, if the stock price increases by 1, it increases the call contracts but decreases the price contracts. Vega, both increase if the volatility increases. Now, conversely, if volatility decreases by 1%, then the options in general across the board will decrease equal to the vega. So if you are a long option, that is if you are buying calls and puts, vega works for you if volatility goes up and against you if volatility goes down. So essentially, you don't want to be ideally holding options when the market is going sideways, because you lose volatility. Okay, so let's just mention a couple small things about being extremely out of the money. The first common mistake people get when they start buying and selling options is they buy really cheap and really out of the money contracts because they say, hey, look, it's only cost me $10. It's cheap, it's attractive. It only cost me $10. It won't cost me a whole lot if I lose it. That is true. You would only lose $10 if you buy an extremely out of the money long contract. But the problem is that the delta is very low, which means that for every dollar the stock goes up, That call contract you bought will not be going up by a whole lot. It'll be pretty much pinned at a very specific area because it's so deep out of the money. Additionally, you have to be aware that IV is typically higher as you go further out in the option chain, aka further out of the money. And that also essentially means that when you're so out of the money, volatility matters more than the actual price of the stock moving up and down. And that makes sense from a conceptual standpoint, because if, let's say, Apple's at 120 and I buy a 240 strike call option that's expiring this Friday, that's crazy. It's lunatic, because although that option is very cheap, it's cheap for a reason, right? You get what you pay for kind of thing here, because for me to buy a 240 strike on Apple is essentially saying that I expect Apple to almost double in price by expiration. Otherwise, my investment's worth nothing. Now, do you think, or does the market really think, that Apple's going to double in price in a week? Probably not. Hence why those options are really cheap. If those options were not so cheap and were really expensive, that's pretty bad. And you should definitely not buy it. There'd be what you would call an arbitrage opportunity, which we will delve into at a later point in time. Just remember that finally, when you're playing really out of the money options, time value makes up a large portion of the option value, which makes it difficult, because remember that time value always works against you if you're buying in options. So, regardless of what Apple does, you're losing money every day. And that's a difficult thing to swallow. So you have to remember that extremely out of the money options can be very attractive. They seem really cheap and they go up and down by 100% a day. But beware that those are riskier and you can typically lose a lot of money in a day as well. So just keep that in mind. Okay, so I've gone over the basics of stocks and the basics of options. And now I want to step back a little bit and talk about the mental game, because I don't think there's enough talk about this. I don't think that people remember this when it comes to trading, especially for the people who are new. You really need to keep this in your head. Remember that being profitable and staying around for more than a year or two is not because you made really good trades once or twice. The reason why you stay is because you have good mental ability and capacity. Being confident, calm, and always making trades with a clear mind. Okay, let's dive into that. Bad mental game is the biggest reason why people fail. This is pretty much a fact. Okay, if you can be making money hand over fist, and then all of a sudden it takes one bad trade and you're out, you could lose your pension fund. You could lose your part of your retirement, your savings. It could be anything. And so you have to understand that no matter how much money you make, you have to be cognizant of the risks. The risks are always there, regardless of how much money you make. And you can lose it all again and more. And it's an issue that many people have made, especially starting out, okay? And I'm just trying to help you avoid this mistake as much as possible when you're starting out. So bad mental game is a big reason why people fail. What does it mean to have bad mental game? If you're making investment decisions where you're angry or you have a lot of emotions, you're sad, or something serious happened in life, it could be that your marriage is in trouble, or it could be that you're having difficulty in school. It could be that your boss just fired you. You got your family members in the hospital, or anything, or a combination of those things. That means you're not comfortable and calm. And when you're not comfortable and calm, you make bad investment decisions. And those investment decisions can cost you your whole account. It can cost you your savings. And I'm just helping you avoid that. The four main emotions you want to avoid when making any decisions when it comes to trading is hope, greed, fear, and regret. And I always mention these four because when I first discovered them, I thought, that makes a lot of sense. Most people typically trade on hope, greed, fear, and regret. And if you make a trade based on these things, let me tell you, the market's not out to get you. But if you're trading like you got, you're high on hope, and that's all you're trading it on, eventually you're going to lose. Okay, market's not a place for you to be trading on hope or greed. It's based on sound decision making, patience, and risk mitigation. And we're not going to go on all those topics today. This is supposed to be an introductory course, but just be aware that if you are making your own decisions outside of Stonks Society, I hope you do at least take this away, if nothing else. Moving on, the newer you are to trading, the less money you should trade with. This is almost a universal thing most people suggest. If you have, let's say, $20,000 to trade with, and you're a newbie, like, do not put in anything that you'd be okay with. Don't put in anything more that you'd be okay with losing. So, for example, if you put in $5,000 of your 20K savings, think of it like this. Make sure you can confidently say to yourself, honestly say to yourself, that you're okay with losing $5,000. Make sure that you don't need that money for rent, that you don't need the money for hospital bills, you don't need the money for the mortgage. Because if you need the money for any of things, or for example, to pay down credit card debt or student loans, don't use that money to trade. You should only be using money that is free and clear, that there is no requirement that you must pay it back by an X time, or that there is interest involved with that money. Because by doing that, it messes with your emotions, which is exactly what we're trying to avoid if you want to have confident and clear mental game. And that's exactly what we're going to try to do at Stonks Society. So going back to that example, if you have 20K, first make sure that you only set aside what you're willing to lose and that is not being chased after by some other party, like the bank. Okay? So if you, let's say, put down $5,000, you're saying you're okay. It's okay if I lose 5,000. It'll be a learning lesson. Worst case scenario. And you set that ground rule for yourself. Say, hey, look, 5,000 is the most I'm willing to lose. Say, hey, look, if I make a trade, I'm willing to lose up to 10%, 20% of my investment before I say no more. And you sell out. It's a very important thing to set a max loss for yourself when it comes to trades. It's also important to set max profit levels for yourself to take money out of a winning trade and make sure that you're not over leveraging yourself in one position that could blow up at any given moment. That's also why people like Warren Buffett and pretty much any proper investment manager out there will tell you to diversify. Don't put all your money into one basket. Don't put all your eggs into one basket, I should say. Okay, if you have $5,000 to trade with, you should not be putting all of it into Apple. That's basic risk mitigation. Okay, at least spread it out across 5 different plays. And if you can't find 5 different plays, put it in your money, just your cash. Just let it sit there. Save it for a rainy day, as Warren Buffett likes to say. Save it for a rainy day until a really good opportunity comes along and you've got the money, you've got the capital, free and clear to use. And that is what makes your mental game powerful, because you can set ground rules for yourself and then follow them. Following through with them is the most important part. But I understand that there are days where you don't have good mental game. Maybe something happened that day. Maybe you got an F on a report. Maybe you didn't get that raise you're looking for. It could be minor things, right? But if you feel that you're trading with over emotion, take a breather and just don't trade. Because it's okay to not look at charts all day. It took me a while to sort of get to this realization myself, but it's important to understand that you do not need to be looking at charts from 9:30 a.m. to 4 p.m. Eastern time every day, because that sucks the life out of you. Be aware that it's completely fine and encouraged to step away from the computer or step away from your phone just to go outside and relax with a mask on. But just remember to be realistic about your profit expectations. I was mentioning 100% gains today, and it's true. You know, Senpai just took an account from $500 to $20,000 in a few weeks. Now that guy's insane. He's great. He's beyond amazing with his plays. But you have to understand that not everyone will be this profitable, and you need to set an expectation that you can make realistically without going insanely risky into specific plays. And this is not the area for us to be talking about setting profit expectations, but you do what you think is best. And if you'd like some help, we're definitely here to give you some advice on Stonks Society Discord. So feel free to jump in if you do have questions or follow up after the presentation's done. Okay, let's go with some charting basics. I'm not going to go really deep into it, but I just want to give you the basics of what we typically do in our server in order to obtain plays. Charting basics is just understanding the prices, historical prices of a stock over time. And we typically like to say to use support and resistance because that is a strong area where buyers and sellers are moving, or where prices were reversed and there is tension in the stock price, which can provide opportunities for us to buy and sell at opportune times. Of course, just because there is support and resistance does not mean that it will guarantee a profitable trade. It only suggests that there is a precedence to do so, and never a guarantee. Another common charting method is to use price trends or trend lines in order to create opportunities of a squeeze or a buy and sell signal. We can also use indicators. You may have heard of RSI, MACD, SMA, EMA, Bollinger, Fibonacci, ACDC. We can keep on going, and there's a lot of types of indicators out there. I want to let you know now, there is no right answer for which indicator is best. Okay, one person might be using RSI, another one might be using MACD, another one might be using only Fibs or Fibonacci, and that's up to you. Remember that whatever indicators or signals you use is relevant to you because you believe in it and you've tried and tested that strategy. Otherwise, everyone would be using the same strategy. There's diversification in the indicators and how each investor views a chart, a technical analysis chart. And that's the basis of why there are buys and sells all the time at the same price, right? For remember that whenever you're buying a share, that means someone else is selling that share to you. Now, they might have different reasons why, but you have to understand, for 100 buyers, it's 100 sellers. It has to match supply and demand basics. So you can have all these indicators. You can have all of them. You can have support and resistance. You could study hours and hours on a single chart, and you could come up with a buy signal where another guy down the street could say sell. And this discourse is exactly what allows us to become to get to an equilibrium price in the market for any given stock. And lastly, I also want to highlight volume bars when it comes to charting, because volume is very important to understand where the buying and selling is and how strong the buying and selling is. So if you get a huge volume bar, that means that a lot of people were buying and selling on that particular time period. And that also can be an indication of things to follow. So before I mentioned support and resistance, here's a very common example of using support and resistance. The black line represents the price over time. Similar to the black and red that I had showed before. Here, we've overlaid support and resistance areas where the price seemed to bounce back and forth before it finally broke above, and then the new resistance became support, as you can see. It's the same price level, right? But now the resistance has become support. So again, support and resistance is where people are buying and selling, and there seems to be potential for a reversal into another direction. And maybe there's a squeeze of prices, for example, which can offer opportunities to buy and sell opportune times. Imagine if I had bought at the bottom of that support and then sold at the top of the resistance. That's a lot more profitable than just simply buying and holding once. Because if I can buy at support, sell at resistance, buy at support, sell at resistance, buy at support, sell at resistance over and over again, I can not only double, but triple, quadruple my gains in the stock market. That's the basics of trading. Timing the market. Difficult, risky, but huge profits if you've done right. Let's talk about candles now. Candles are a technical analysis basic. If you're going to be studying charts, you need to know this, and you need to really keep it ingrained in your mind. This is what you would be staring at day in, day out if you're doing technical analysis. We have two main types, which are bullish and bearish candlesticks. But regardless of which type of candlestick it is, green or red, there will be four main things you need to know about it, which is the high, the low, the open, the close. The high is the top of the whisker or the wick that you see. The low is the bottom whisker or wick you see. And the open and close is dependent on whether it's a bullish or bearish candlestick. So as you can see from the picture I have here, if it's a green or a bullish candlestick, that means it opened at that lower level and closed at that higher level. Conversely, if it was a bearish candlestick, it means that the price went lower in that same period, right? So it had to have opened higher and closed lower. Now, candlesticks or candles can be showing price action for any given time period. So if I showed you this green and red candle, this does not tell you how long that time has elapsed. It could just be showing price action for just 1 minute. It could be showing price action for a month, right? You don't know how much time has elapsed between the open and the close. All you know is where that price was during that time period. So what determines how much time each of these candles represent? It's the time interval or the time period that you choose when looking at graphs. And we'll get into an example later on when Senpai does a basics on that later on tonight. So let's use an example. I actually just pulled Tesla. This is a Tesla graph here. This is an up-to-date type of Tesla based on Friday's action. But I want to wind it back to this sort of like a late summer period where we had a nice breakout that we traded in our server. If you guys remember, Senpai was, at the time, he was posting on Facebook saying, guys, I'm very bullish on Tesla. The stock is only at 400, but I expect it to be $630 by, I think it was December 6th or December 7th. It was December 7th. He said, I think it'll be $630 by December 7th. He said something really crazy. That's an insane price increase. Almost, was it 50% increase on the stock, something crazy? And he said that it would happen in just a month, something crazy like that. And the reason why is because he noticed that the prices were bouncing up and down in this range that I've indicated from these two lines here. This is very basic analysis, but it shows that there appeared to be a squeezing of the prices using the same candles that I explained before, right? And then as you see, when it started to break that triangle, you see volume at the bottom, those little colored in blue bars, those rectangles, indicate volume for every single candlestick. And as you can see, as those candles started rising in volume, you can also see that the chart for Tesla also followed through. You get a huge boost up in a couple days of price action, and it continues going forward. What we call mooning in this case, just going to the moon. Tesla ended up hitting well over $650 later that month. Yeah, what's up? Did I hear someone? Okay. Maybe that was just feedback. But either way, this is a insanely crazy trade that Senpai was able to use effectively in order to make sure that he got a lot of money for a server off of that. I'm not the girl that I used to be sometime.